the quiet awakening of the currency revaluation narrative. For over a decade, discussions about the potential revaluation (RV) of certain global currencies, particularly the Iraqi Dinar (IQD), the Vietnamese Dong (VND), and the Zimbabwean dollar (ZWL), have stirred debate, skepticism, and at times, fervent belief among different pockets of the investment community. To many in mainstream finance, the entire idea that these struggling or undervalued currencies could suddenly leap to strong global parity rates has long been dismissed as fantasy, more akin to internet folklore than to serious financial strategy. Yet in recent months, and most acutely in the past few weeks, something distinct has been happening beneath the surface of conventional finance. Silent but significant shifts are being noticed in the infrastructure of major banks and currency exchange systems across the United States. For those who have held on to these currencies for years despite ridicule and doubt, the atmosphere feels palpably different. Signals are beginning to point not toward a rumor-driven community narrative, but toward measurable institutional activity that suggests serious preparations are underway. From rumor to operational signals. Historically, banks and financial institutions responded to inquiries about the dinar or dong with canned statements designed to brush off speculation. For years, rate screens for these currencies sat inactive, and frontline staff were often instructed to dismiss questions outright. That climate, however, appears to be shifting. Reports indicate that banks are now quietly updating internal systems, activating live rate screens, and modifying teller software to include these long-dismissed currencies. Exchange locations that had remained dormant are being refreshed, and insiders suggest that preliminary access to real-time rates is being granted to carefully selected redemption officers. This shift in posture represents far more than casual interest. It indicates active planning. Banks rarely invest resources into major system updates without clear timelines, confirmed directives, and the assurance that liquidity and compliance frameworks are already in place. If such updates are indeed taking place, it suggests three critical realities: readiness, liquidity, and synchronization. 1. Readiness: staff must be trained, physical sites prepared, and systems tested before redemption could occur. 2. Liquidity: substantial reserves and capital backstops must be secured to prevent disruptions in financial stability. 3. Synchronization: the fact that multiple banks appear to be moving in lockstep strongly implies central coordination, likely involving the U.S. Treasury and international regulators. The significance of these changes cannot be overstated. What was once a theoretical debate in private forums now seems to be manifesting in the form of tangible infrastructure developments. A soft launch approach. Unlike splashy public financial rollouts, such as product launches or government announcements, the RV conversation is not expected to make immediate front-page headlines. Instead, insiders describe the process as a soft launch. This quiet, incremental activation strategy allows banks to stress-test their systems, staff, and liquidity arrangements without sparking a sudden rush of public participation. By keeping the rollout subtle, institutions protect themselves from destabilizing surges of demand and prevent speculative chaos. The controlled process also allows liquidity preparation, ensuring cash reserves and digital payment mechanisms are ready. Compliance coordination, aligning with anti-money laundering protocols and global financial regulations. Security enhancements, safeguarding against fraud, counterfeiting, and system exploitation. Rather than a single dramatic announcement, the revaluation process, if indeed it is unfolding, appears to be designed as a series of phases, gradually expanding from internal testing to broader public accessibility. The Iraqi Dinar IQD, from exotic to mainstream. Of all the currencies associated with RV speculation, the Iraqi dinar has consistently remained at the center of the conversation. Once categorized as an exotic currency with little international standing, the IQD has shown signs of moving toward mainstream legitimacy. One of the most telling developments is Iraq's dramatic increase in foreign currency reserves, now reported to exceed $100 billion, an unprecedented peak. These reserves act as a critical financial buffer, allowing the Central Bank of Iraq, CBI, to maintain stability in exchange rates and, crucially, to back any potential currency appreciation with real liquidity. Alongside this, Iraq has been implementing a wide range of institutional reforms. Anti-corruption campaigns, aimed at restoring confidence and credibility in financial governance. Digitization of payment systems, bringing Iraq's banking infrastructure in line with international norms. Modernization of financial processes, ensuring the country can operate within strict global regulatory frameworks. These reforms not only stabilize Iraq's economy, but also demonstrate its readiness for deeper integration into the global financial system. Speculative projections from economists suggest that if a revaluation were to occur, potential rates could range between $3.40 and $4.50 per USD. While still speculative, these numbers align with Iraq's oil-backed economic strength and its steadily improving fiscal position. For U.S. investors holding dinar notes, such a shift could represent life-changing returns. The Vietnamese dong VND, the quiet economic powerhouse. The Vietnamese dong has long been considered the second foundational pillar of revaluation speculation, often paired with the IQD in investor circles. Unlike Iraq, Vietnam's story is one of rapid modernization and integration into global trade systems. In the past 2 decades, Vietnam has transformed from a largely agrarian society into one of Asia's most dynamic export-driven economies. With strong performance in electronics, textiles, and consumer goods, Vietnam has become a preferred hub for multinational corporations seeking alternatives to Chinese manufacturing. Major global institutions such as the International Monetary Fund, IMF, and leading rating agencies have gradually upgraded Vietnam's financial status, moving it from frontier market classification toward emerging market recognition. These developments reflect growing confidence in Vietnam's stability, fiscal management, and long-term growth trajectory. Speculators estimate that in a post-RV scenario, the VND could potentially trade between 47 cents and $2.95 per USD, depending on the liquidity structures and rollout phases implemented. Even at the lower end of this range, returns could be substantial due to the currency's accessibility and historically low acquisition cost. The Zimbabwean dollar ZWL, high risk, high reward. While often less prominent in mainstream RV discussions, the Zimbabwean dollar represents a unique speculative play. Zimbabwe's long history of hyperinflation made the ZWL nearly synonymous with financial collapse. Yet, in recent years, the government has begun taking bold steps toward stabilization. One of the most important reforms is the move to back the ZWL with Zimbabwe's substantial gold reserves. As one of Africa's top gold producers, linking the currency to physical resources could provide the credibility and stability necessary for revaluation. Additional reforms include stricter fiscal oversight, controlling public spending, central bank tightening, reinforcing monetary stability, tax restructuring, enhancing predictability for both domestic and foreign investors. Analysts suggest that if reforms continue successfully, the ZWL could stabilize within a post-RV exchange range of 12 cents to 50 cents per USD. While volatile and riskier than the IQD or VND, the ZWL offers investors both diversification and potential for outsized returns, if Zimbabwe's economy continues on its reform path. Expert insights from theory to practice. 3 respected professionals in economics and banking have weighed in on the latest developments. Dr. Michael Andrews, geopolitical economist, argues that Iraq's strong reserves and removal from the exotic currency category signal an imminent movement in the dinar's value. Sarah Kim, forex strategist, highlights the significance of banks quietly activating exchange sites as evidence of live system testing. Jonathan Harris, banking systems consultant, emphasizes liquidity as the key factor, pointing out that banks would not update internal systems unless funding pools were already secured. Their combined perspectives lend credibility to the idea that the revaluation narrative is no longer driven by rumor, but by observable systemic alignment. The transition from if to when. For years, the central question among dinar and dong investors was, will this ever happen? Today, the conversation is shifting toward, when will exchanges take place and where? This transformation, from abstract speculation to tangible logistical planning, marks a milestone for the community. With institutional actions now visible, the possibility of revaluation appears less like wishful thinking and more like a scenario unfolding in deliberate phases. The first stage is expected to involve private testing windows for a limited group of investors, followed by wider public availability as systems stabilize. By rolling out gradually, global banking institutions can minimize disruption while maximizing stability. In many ways, what is happening now represents the quiet but decisive transition from rumor-driven discussions to measurable, coordinated preparations. For investors who have waited years in hope, the signs point to the early stages of what could become a historic financial shift. The road ahead, phases, implications, and strategic outlook of currency revaluation. The developments surrounding the Iraqi Dinar, IQD, Vietnamese Dong, VND, and Zimbabwean Dollar, ZWL, are not merely financial curiosities. They have the potential to reshape parts of the global monetary landscape. If the signals currently being observed within the banking sector are accurate indicators of an imminent or phased revaluation, then we are witnessing the early stages of a financial event that could rival some of the most significant currency shifts in modern history. While Section 1 established the foundation of how speculation is evolving into tangible banking action, this section takes the analysis further. What exactly does a revaluation process look like in practice? How might it ripple across the global economy? What risks must investors prepare for? And what strategies could maximize outcomes in a landscape where the extraordinary suddenly becomes possible? The multi-phased rollout strategy. One of the defining features of the current situation is that banks are not rushing into an all-at-once activation. Instead, experts and insiders consistently describe the unfolding process as a multi-staged rollout, designed to ensure systemic safety and market stability. Phase 1, private testing windows. Limited groups of pre-screened individuals, often described as whales or institutional participants, are granted early access to exchange at new rates. This allows banks to evaluate their infrastructure under real conditions without the chaos of mass redemptions. Early participants also serve as a test of compliance, anti-money laundering frameworks, and fraud prevention protocols. Phase 2, tiered bank activation. Major Tier 1 banks, Wells Fargo, Chase, HSBC, and others, gradually open more exchange sites. Redemption officers receive training for higher volume traffic, and live rate screens become more widely available across internal systems. Still, public knowledge remains limited to prevent a surge before systems are fully stabilized. Phase 3, controlled public rollout. At this stage, information leaks into mainstream financial media, though still without a dramatic government announcement. Selected branches nationwide allow retail-level exchanges, though often with limits or appointment requirements to manage traffic. This stage bridges the gap between internal systems readiness and mass participation. Phase 4. Full market integration. Once liquidity flows are secure and exchange centers are fully staffed, a broader public announcement may finally occur. Currency markets, Forex, reflect the new exchange rates, and the dinar, dong, and ZWL lose their long-standing speculative label. At this point, investors who have waited years may finally realize the full potential of their holdings. This phased approach underscores the delicate balance institutions are trying to strike, enabling the revaluation without destabilizing the very financial system required to sustain it. Global economic implications. The revaluation of even a single national currency has global repercussions. The simultaneous activation of three, especially ones with substantial speculation tied to them, could represent a shock to the existing economic order. Impact on Iraq. Strengthened sovereignty. A stronger IQD would give Iraq far more leverage in international trade, particularly in the energy sector. Domestic stability. A stronger currency could stabilize prices at home, reduce inflationary pressures, and attract foreign investment. Geopolitical leverage. Iraq could emerge as a pivotal energy and financial player in the Middle East, reducing reliance on external aid and IMF programs. Impact on Vietnam. Global trade reinforcement. A stronger dong would further cement Vietnam's role as a global manufacturing hub. Capital inflows. Foreign investors would see the dong as a safer bet, increasing FDI, foreign direct investment. Regional competition. Vietnam's revaluation could challenge China's regional dominance in manufacturing by making Vietnamese exports more expensive but also more credible. Impact on Zimbabwe. Reputation reversal. A stabilized, gold-backed ZWL could reverse decades of hyperinflation stigma. African finance. Zimbabwe could position itself as a test case for resource-backed currencies across Africa. Fragile balance. Success depends heavily on political stability and sustained policy discipline, something Zimbabwe has historically struggled with. Impact on the US dollar and global finance. Dollar strength versus liquidity management. With US investors holding significant IQD and VND reserves, large-scale exchanges could temporarily inflate US dollar demand. Banking liquidity challenges. Banks must carefully manage the inflow of redeemed currencies to prevent market shocks. Shift in Forex dynamics. The RV could challenge assumptions about which currencies qualify as major or exotic, potentially redrawing trading strategies. Investor strategies for a potential RV. For individual investors who have quietly accumulated IQD, VND, or ZWL over the years, the transition from speculation to reality could be life-altering. However, preparation and strategy are essential. 1. Documentation and verification. Investors should ensure their currency holdings are genuine and verifiable. Counterfeit notes remain a serious risk, particularly with currencies historically plagued by black market circulation. Receipts of purchase, certificates of authenticity, and proper storage in secure facilities can smooth the redemption process. 2. Tax and legal preparedness. Gains from revaluation will almost certainly be classified as taxable events. Investors should consult with tax professionals to prepare for capital gains or income tax implications. Structuring redemptions across different tax years could minimize liability. 3. Diversification of redemption. Instead of exchanging everything at once, investors may consider phased redemptions. This reduces risk, allows for flexibility if rates adjust, and prevents sudden financial mismanagement. 4. Asset protection. Sudden wealth can create both opportunity and vulnerability. Investors should consider trusts, legal entities, and professional advisory services to protect new assets. 5. Exit planning. Having a plan for what to do with the new wealth is critical. Without structured goals, many investors risk squandering gains. Real estate, diversified portfolios, and sustainable business ventures represent potential avenues. Risks and challenges. Despite growing optimism, investors must remain grounded in the risks that accompany revaluation speculation. Risk 1. Timing uncertainty. Even with visible banking updates, the precise timeline of revaluation remains unknown. It could occur rapidly or stall for months due to geopolitical or financial constraints. Risk 2. Rate discrepancies. Projected rates $3.40 $4.50 for IQD, $0.47 $2.95 for VND, $0.12 $0.50 for ZWL remain speculative. Actual rollout rates could be lower, especially during early phases. Risk 3. Liquidity delays. Even if banks begin exchanges, delays in payouts, staggered appointments, or restrictions on daily redemption limits could frustrate investors. Risk 4. Geopolitical setbacks. Iraq, Vietnam, and Zimbabwe all exist within politically complex landscapes. Instability, policy reversals, or external pressures could derail the RV. Risk 5. Scams and misinformation. The RV community has long been fertile ground for false guru predictions, pump-and-dump schemes, and fraud. Investors must distinguish between verifiable institutional developments and rumor-driven hype. Broader geopolitical context. Currency revaluation is not just an economic event. It is deeply tied to geopolitics. U.S. strategy. By facilitating IQD and VND revaluation, the U.S. could strengthen its alliances with Iraq and Vietnam, while indirectly counterbalancing Chinese and Russian influence. China's role. As Vietnam's largest trading partner and Africa's largest investor, China has a vested interest in how both the VND and ZWL evolve. A stronger VND may complicate Beijing's trade dominance, while a resource-backed ZWL could align with China's interest in commodities. Middle East dynamics. A stronger dinar would enhance Iraq's role in OPEC negotiations and potentially shift energy trade balances. Africa's precedent. Zimbabwe's experiment with a gold-backed ZWL could inspire other African nations to explore commodity-backed monetary strategies, reshaping regional economics. Expert forecasts looking ahead. Economists and analysts offer differing timelines and expectations. Dr. Andrews believes the IQD shift is imminent, given Iraq's reserves and energy stability. Sarah Kim projects that full public rollout will follow swiftly after internal testing achieves confidence, likely in staged waves. Jonathan Harris warns that while liquidity appears secured, the test lies in how effectively banks can manage the tidal wave of redemption demand without market distortion. Their consensus. The transition from rumor to reality is actively underway, though execution will dictate success. The human element, investor communities. For years, IQD, VND, and ZWL investors have formed online forums, conference calls, and private groups where hope and speculation fueled discussion. Often mocked by mainstream finance, these communities persevered through cycles of rumor and disappointment. Now, with tangible bank preparations underway, the dynamic has shifted. The tone within these groups has moved from if to when, and from speculation to logistical planning. Which branches are quietly preparing? How will appointment systems work? What documentation will be required? The psychological shift cannot be underestimated. For many, the RV represents not just financial opportunity, but vindication after years of skepticism. Conclusion: a historic inflection point. The quiet but deliberate movements within banking systems suggest that what was once dismissed as internet fantasy is edging toward reality. By structuring the rollout as a phased, low-profile process, institutions appear to be managing the extraordinary challenge of converting speculative currencies into globally recognized assets without destabilizing markets. For Iraq, Vietnam, and Zimbabwe, successful revaluation could mean financial sovereignty, global integration, and a future far removed from their turbulent monetary pasts. For investors, the outcome could range from modest gains to transformative wealth, depending on timing, strategy, and discipline. Ultimately, the unfolding story of the IQD, VND, and ZWL revaluation may be remembered as a defining financial transition of the 21st century, a moment when patience, preparation, and foresight converged with geopolitical and economic necessity to create one of the most remarkable shifts in modern monetary history. Disclaimer: all content provided by IQD Global Intel is for educational and informational purposes only. We are not financial advisors and do not provide investment, trading, or banking advice. Viewers should always conduct their own research and consult with a licensed financial advisor before making any financial decisions.